Looking at the global economy, we need to pay attention to what is going on in China, what is going on in the euro area, and the expectations of inflation and rate cuts. Let's start with China. China has been growing massively in terms of its market share in automotive production. Not just an incredible surge in market share, but seeing this graph, what it shows is how Europe, Japan and the United States have been declining quite steadily. Japan quite stable, but in terms of Europe, the entire destruction of the market share in the automotive sector has come from an increase in the China market share. Now, what we need to understand is what can happen in the future, because the European Union has given its future in terms of the automotive industry to China for free. With its decision to abandon combustion engines and to focus entirely on electric vehicles, it has basically destroyed the automotive industry in Germany and in other European countries, and at the same time, it is losing competitiveness because Chinese companies are much better in terms of technology, access to raw materials and price than the European ones. It's a very, very challenging environment. In this graph, what we can see is that Chinese growth is considered to be very weak. However, if we look at the details in general, they're not as bad as one would imagine. Retail sales are growing almost at 5%. The industrial production is also growing at 5%. And in the case of fixed investment, growing slightly less, but at 3.4%. Therefore, what we can see is that the Chinese economy is much stronger than it looks, and certainly much better than what we can imagine relative to, for example, the European Union. It's very important to understand that this is happening in the middle of a very significant challenge in the real estate sector. So once you have that challenge included in estimates, the fact that the economy is growing at around 3.5 to 5% is actually a pretty good number if we look at what is going on in the euro area, which is atrocious. You may hear a few times and you may read that the solution for the world economy is to increase government spending, increase taxes, and strengthen the public sector. Well, France is showing you that that is exactly the opposite of what works. In the case of France, what you have is an economy that has the largest government spending to GDP in the OECD at around 58%. There's been absolutely no austerity. Furthermore, it has some of the highest taxes in the world. It has one of the highest tax wedges in the OECD and is one of the least competitive taxation systems in the OECD according to the Tax Foundation, ranking at 36 out of 38 companies. So, massive government spending, huge public sector workforce, about 22% of the total workforce, and enormous taxes. So, what is the result of this allegedly fantastic socialist welfare state? Stagnation, monster deficit, huge debt, and discontent. Stagnation, no growth whatsoever. Huge deficit. France has not had a balanced budget since the late 70s, and if you look at the different estimates of deficits for France with the different budget proposals that have been presented, they all range between 4 to 5 to 6% of GDP. Atrocious, are around 300 billion euro of annual deficit in France. High debt. Very, very high debt, more than 112% of GDP. However, that debt, you have to include all of the enormous liabilities that have not been financed yet, which range around 300% of GDP. Furthermore, what is the result of it all? Discontent, social discontent. Taxpayers are completely asphyxiated, while at the same time the recipients of the alleged welfare state are also angry because they are relegated to be a dependent subclass. So, more government, more taxes, more public sector means lower growth, worse deficit, worse debt, and discontent. The German economy is not only losing relative to where it was. According to Bloomberg Economics, the German economy has lost about 5% of its trend of GDP growth relative to what it was what the trend was in 2019. That 5% may never come back, around 80% of it. Why? Because the destruction of productivity is coming from a number of elements. Number one, the productivity destruction has happened with government policies that have destroyed the German economy. The first one, embracing inflationism and the ECB decision to bloat government spending, to monetize debt, and to implement negative real and nominal rates. What ended up happening was that the Germans inherited inflation created by the ECB. Number two, the misguided energy policy that has destroyed the competitiveness of Germany, deciding to shut down nuclear terminals in the middle of an enormous energy crisis. And now Germany, basically out of its entire electricity production, about 25% is coal and lignite, and about 40% is coming from fossil fuels. The other element is that 76% of its energy consumption comes from fossil fuels, despite 200+ billion of subsidies to renewable energies. So a very misguided energy policy has destroyed the competitiveness of the industry. Furthermore, embracing the 2030 agenda and the cataclysmic decisions of these alleged activists that are leading policies in Europe have led to a destruction of the primary sector and the industrial sector. Germany, my friends, a real challenge. Reduction in GDP estimates, increase in inflation estimates. You couldn't do it any worse. You couldn't do it any worse in an economy that is in stagnation. France is in turmoil. Germany is in stagnation. The euro area is not growing at all. And the countries that are actually showing some growth are doing so by increasing enormously their financial and debt imbalances. A complete disaster. Let's go to the next graph, because all of this ties with the Federal Reserve and what it is going to do relative to rates in 2025. If we can see this graph, courtesy of JP Morgan, what it shows basically is that there is a risk of persistent inflation. Why is there a risk of persistent inflation in the United States? Because of the absolutely enormous government spending, which is leading money supply growth to be faster than was initially expected. This money supply growth coming from government spending, coming from huge deficit spending, needs to be curbed in order to reduce inflation. However, the persistent inflation risk is the number one factor that may derail the path of rate cuts that the market assumes. In terms of communication, the Fed has gone from being exceedingly dovish, interestingly enough, in the last part of the election process, to moving into a message of prudence, a message of persistent inflation, a message of maybe there will not be as many rate cuts as one would have expected. The Fed first panicked in June by delaying its decision to reduce the balance sheet. Second, it also panicked in September by cutting rates by 50 basis points. Those two things happened in the middle of an election process, interestingly. Now, however, they have found persistent inflation and risks of more hawkish policies. Isn't it interesting? Before the elections, everything was dovish. After the elections, more hawkish. Quite significant. Let's go to the next graph. Central bank plus M2, money supply, together has been declining quite significantly in the last months, but declining from a very elevated figure. The most dangerous element for 2025 is that will reverse and go back to new all-time highs as central banks become more dovish, and more importantly, as central banks start to monetize some of the enormous new debt generated by governments in 2024, which had 70 plus number of elections, i.e. a lot more governments spending like there's no tomorrow. Let's go to the next graph, which puts global supply of money into perspective with its impact. And the impact is obviously on core CPI. And what is going on? What is going on is that core CPI, courtesy of JP Morgan, core CPI is stubbornly high. And this is coinciding with a period of enormous rate cuts. So something has to give. Either there is going to be a much slower path of rate cuts. In these rate cut estimates, what we can see is that there is likely to be a much slower path of cutting rates. Furthermore, it can derail on the side of inflation. So we need to pay attention to inflation expectations. We need to pay attention to rate cuts. We need to think of the euro area as almost a forgotten economy for 2025, and we need to pay more attention to the Federal Reserve and its policy, because that is going to be crucial for 2025.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.